Welcome back. Time now to dig into the latest Yahoo Finance morning brief. And today we're taking a look at how markets continue to pay no mind to the "Don't Fight the Fed" motto here. Now, there's been, of course, a lot to dive in on this. And for more, let's bring in Julie Hyman, the author of today's morning brief.
I wrote about this today. Don't Fight the Fed has been around since 1970 when an investor wrote about it in a book. And effectively what it means is that Fed policy has a lot of effect on what happens in stocks, but people have fought the Fed or sort of gone counter to what you might think for Fed policy, basically since the beginning of the markets and the central bank. And the Fed is a lot more transparent now. We know a lot more about what it's doing, but the market doesn't always believe what the Federal Reserve says it is going to do. Witness the so-called dot plot. All the dot plot is the Fed members' predictions of where they think rates will be at a given point in time, the so-called terminal rate, if you will, of this current cycle. So in December, each of the Fed members is represented by a dot, gave us their forecast for where they thought rates would end 2023. And most of them were clustered between 5 and 5.25% in that range, right? If you look at the March projections, it's pretty much the same, right? You see most of the dots clustered in that region. So effectively what that implies is that there would be one more quarter-point rate hike before the end of this year. Does the market believe that expectation from the Fed? Not if you look at swaps markets and futures markets and how they price in probability for what the Fed is going to do. We use the CME Fed Watch tool to sort of try to pin this down and get an idea of this probability. The day after the Fed released that December 14th, that dot plot, here's where the probability stood for the end of 2023. So they were in line with the Fed's own predictions, only 3%. In other words, only 3% of bets being put down were agreeing or believing what the Fed projections were at that point in time. Most of them were clustered at lower places. What about now? With the Fed still clustered around 5 and 5.25%, guess what? They still don't really believe them. So the probability now of that is 8.8%. And to be sure, this number fluctuates quite a bit, right? As of yesterday, it was something like 11%. Earlier this morning, it was something like 6%. So it bounces around a bit, but it's been pretty consistently below 20%. So if you look at 475 to 5 at 27% probability, or if you look at 450 to 475 at 37%, to put all of this in perspective, essentially what this means is that most bets being put on in the market right now imply that the Fed will cut rates before the end of the year. We have seen stocks rally, for example, in part based upon that view. But is that view correct when the Fed itself is telling us that's not what they're going to do? Well, let's talk about this more, Brad, shall we?
Yeah, with the disconnect between investor expectations on rates and the Fed's hawkish tone comes a level of market risks. And here for a deeper dive on this and more, we've got Charles Schwab's senior investment strategist, Kevin Gordon. Kevin, thanks so much for taking the time.
Good morning, guys.
Absolutely.
Good to see you.
So let's dive into this. I mean, because Julie was breaking down that disconnect. She wrote about it in today's morning brief. And why do you think that disconnect currently exists? Why are investors perhaps more optimistic in seeing some type of cut and betting based on that versus what the Fed is communicating?
I think it's still, well, there's a couple of fights going on in markets, which is interesting because you have the bond market clearly fighting the Fed, assuming and expecting that there will be rate cuts this year. And then the stock market, in a way, is fighting it, as you were mentioning, Julie, with this expectation that somehow, number one, cuts this year are going to happen. Number two, that would be bullish. I don't really know how that's the case because especially with this particular Federal Reserve, how much they want to keep policy tight, stay at a restrictive level for some time. A turnaround after they get to the terminal rate, whether that's in May or after, a quick turnaround to cuts, in our view, would only happen in the context of pretty dire economic and or labor market data. And at the outset, that's not bullish for risk assets. It's certainly not bullish for stocks. So I think that's probably the disconnect. And it's a little bit ironic, too, because even if the market sort of is right in pricing in cuts, as I was mentioning, it's not a good backdrop sort of at the outset. So maybe, in the future, once you get to, the sort of zero lower bound, not zero rates, but kind of the lower bound of the Fed's rate cutting cycle. But at the outset, I don't think that's a positive backdrop.
And so how does this kind of set stocks up this year? If you're fighting the Fed in those various different ways, does that then mean that there's a decent amount of more risk of more downside?
Yeah, I think that the disconnect will be a volatility driver. I'm not sure it's going to look the same as it did last year because you have to keep in mind, the tightening in financial conditions that the Fed's looking for this year, I would argue is actually a little bit different than it was in 2022. I think last year was more kind of the market-based financial conditions data, all the indexes that we track, but they're more markets reliant. I think this year, and particularly what happened in early March, it's much more of a credit story and a real economy, financial conditions story. Most recently, members of the Fed, including Austin Goolsbee, who's the newly minted Chicago Fed president, has been talking about that, where there's an expectation that you start to see a tighter credit environment, more restrictive lending standards, which we already saw going into SVB. But with that expectation, the lags are still in process and still working. It's just harder to see. I think it's easier to see on a day-to-day basis with market data, but we just have less clarity now, and it takes a little bit of time to feed through. So in our view, that's kind of the story of the market maybe moving away from inflation-based data and kind of more into real economic data, i.e. the labor market, as kind of the next driver, of volatility in this year.
Yeah, and credit is also something we've heard some Fed officials start to talk about. I believe John Williams, New York Fed president, spoke last night and talked about that. We've got more Fed officials talking today. And on the topic of financial conditions, your colleague Liz Ann Saunders tweeted a chart of financial conditions yesterday, which are actually now loosening again. I mean, it makes sense they would be loosening to some extent after the big tightening that occurred in the wake of SVB's collapse. But that chart does not support the Fed stopping.
Yeah, and that's the hard part is you have a real kind of real-time metric like that. And that's more market-based, which is the tough part that, year to date, financial conditions in a market sense, they've eased because you've had equities rally, you've had yields not, move back to their highs, and then the dollar is eased as well. And then the step down in sort of the size of rate hikes from 75 basis points last year to now 25, that has all contributed to an easing in financial conditions in a market sense. The hard part for the Fed is that their bet is for this year, the real economic data start to tighten and get worse, but that takes longer to feed through. And, policy we know acts with a lag, as you were saying. I mean, I don't think it's a coincidence that a full year after the Fed started raising rates, you had 2 major bank failures. So I think that you probably have more to go, not necessarily maybe on the banking side, because they did a lot to sort of stem the bleeding there, but probably on the consumer side, maybe on the labor side. And, we have to keep in mind, that's a feature of what the Fed is trying to do. It's not a bug. They really need to see more softening in the labor market, which they haven't seen, I would argue, to the degree they want. Even on the inflation side, I don't think that they've seen a lot of progress, which they've been telling us. But you need both of those components to work in order to get to, closer to what their goal and what their estimate is for this year, and it hasn't happened yet.
Okay, so for a portfolio strategy perspective now, how does an investor, I guess in two ends, an investor that still says, you know what, I'm going to put my boxing gloves on. I'm going to try and fight the Fed. Mm-hmm. How can they perhaps best mitigate some of the risk that they're going to be taking on in that? And then on the other side, for someone who says, you know what, I'm going to listen into the Fed. I'm anticipating the moves that they're going to make, paying close attention to that. What is the sector play? What's the strategic play for them?
Yeah, so I haven't approached it as much from a sector-based view, which we've all talked about a lot. But from a factor perspective, I think what's really nice in this environment is that you can pick. You've all been talking about kind of pricing power and the ability to withstand higher margins in this environment. It hasn't been easy for a lot of companies. So with the number of companies exhibiting that quality shrinking, continuing to shrink, that's been the case since kind of early last year, you want to look for companies that have those qualities. And the nice part is that you can apply that across sectors. So I'd pick, the tech sector, for example. It's kind of the most talked about. Even within a sector that's done really well year to date, you've had the best performers in that sector with the strongest profit margins, and the worst performers have the weakest. They also have the highest leverage. They have the lowest interest coverage ratios. So even within a very large sector, tends to drive the market more often than not. You can have a pretty wide dispersion in performance that way. So I would think of it in the Fed perspective that way. From a recession, point of view, if we do go into one this year, which we think this ultimately turns into a more formal recession, I think you still have to be choosy and pretty picky in what you're looking at, because the traditional defensives like staples or utilities, some of those benefited a lot from the wave of inflation that we saw, and their revenues haven't yet corrected down, and they haven't corrected on the hiring side too. So keep the cost dynamic in mind when you're looking at those names too.
Yeah, good point, considering inflation and all of the rest of the dynamics too with those kinds of names. Thank you so much, Kevin.
Thanks, guys. Good to
see you.
Thank
Good to see you in person. Kevin Gordon, Charles Schwab, Senior Investment Strategist.